shifted macroeconomically since we spoke with our guest last? A jumbo Fed rate cut, of course, the job normalization that we've been watching, there's some wonkiness there to the US labor markets, and the China stimulus that has entered the overall markets theater. Have these events ultimately impacted our guest's outlook on the business cycle, the global business cycle, and why is she looking to Canada in some ways for guidance on where things are going? Joining me now for a look at all of the health of the global business cycle and how that ultimately may shape investment decisions in the months ahead is Fidelity US Asset Allocation Research Analyst, Cait Dourney. Hi, Cait. Welcome back. Good to see you again.
Nice to see you, Pamela. Thanks so much for having me.
Delighted to have you here and be able to speak with you on a day. I'll invite everyone to send their questions in over the next half hour for Cait. But on a day where we've seen inflation, kind of stay the same, go up a little bit, but not budge much. And then we have a jobs and initial jobless claims number that's massive. Bigger than we've seen in almost a year and a half. A real tale of two cities. What does it spell to you for where we sit in sort of this macroeconomic landscape?
A lot has happened since we last spoke six weeks ago, but our views actually haven't changed that much. And I think that was borne out in the data from this morning. So when we spoke last time, we talked about this resilient growth and inflation backdrop that we're seeing in the US. It's been happening for some time. And within that, some normalization of the job market. I think we really saw both of those things this morning with the prints that we got. So first on inflation, inflation was a touch hotter than the street expected, both on the core and on the headline measures, which is really in line with our team's view of inflation, staying stubbornly right around 3%. So we can talk more about kind of what the drivers of that are. So that was kind of a check in what we would expect to see. The second thing we saw is we did see, initial unemployment claims, which are a great indicator that we get every week. We saw this come out. We saw them print a little bit higher, as you said. I will say that we should be a little bit cautious in any one print in that. So first of all, for this print specifically, the survey week was impacted by things like the few-day port strike that we had in the US. It was also impacted by one of the hurricanes that we've been faced with here in the US. So a little bit of noise entered into what is already can be a little bit of noise to week. When we look at kind of a broader trend on claims, we actually see that they're falling relative to where they were in the summer, which is typically what you see as you transition from the summer through into the fall. So not too concerned about that one number, but we can talk kind of a little bit more about the outlook for the labor market.
Well, and first of all, let's come back to sort of what you were talking about 6 weeks ago. And that ultimately, the conclusion was you still see expansion. And that sort of pointed to the business cycle and which part of it we were in. Why don't we just sort of touch there? Expansion sounds like what you're saying, still very much the case?
Yes, that's still our base case. And if you remember, we talked about the way that we think about the business cycle is we run these models where we estimate where we are in the cycle based on history. And then we also look and do deep dives into the cycle today and say what might be different relative to those past periods. And so our model-based measures are telling us that far and away the highest likelihood is being in an economic expansion. So if you sum up our probabilities of being an early cycle, mid-cycle, or late cycle, it tells you there's over an 80% likelihood that you're in this expansionary phase and not in contraction. And, it's been that way with that highest likelihood of expansion really since the mid part of 2020. So we're kind of firmly in that phase. There's always different flavors of expansion that we can talk about, but when we also look at what is different about this cycle, we do see a particular strength in the consumer and the corporate sector that give us additional kind of conviction and comfort over and above those model-based probabilities of being an expansion.
So that's fascinating. And I guess let's come back to the consumer. If we can just couch it, ultimately get a flavor of sort of the asset allocation in a time of expansion. So, this would point to risk assets to the extent that you have made sure they're balanced and hedged in the places that they need to be. But this is kind of an equities call at the same time. I'm asking you a broad question, but can you answer that?
Yeah, for sure. So our asset allocation recommendation coming out of all this research is an overweight to equity beta. It's a more moderate or smaller sized overweight than we would have, say, in the very early part of the cycle when you're seeing that accelerating growth backdrop, accelerating profitability backdrop, or a kind of a true mid-cycle period, which is what we've been in for the last 18 months. But where we are today with growth, GDP growth growing above 3%, corporate earnings growing above 10%, Fed that's moving toward easing, and then these high likelihood of being in an expansionary phase, that to us warrants a modest overweight to equity beta.
Okay, let's go back to the inflation story. I got to ask you about the jumbo rate cut. Was it needed? What did you think? And what are the drivers of inflation that you're watching right now? But let's begin with sort of, should they or shouldn't they have done that jumbo rate cut?
Yeah, it's a difficult one. So I think the way that I think about the Fed is they have an estimate of neutral, a long run neutral rate, where they should be to neither make growth slow nor accelerate, and neither make inflation, slow nor accelerate, and stay right around their 2% target. And where they are today is they've made a lot of progress on inflation, with core inflation having come down to 3.3, which is where it printed this morning, all the way from 6. And we've had growth that stayed, pretty good. And on the employment side of their mandate, they've seen some loosening in the labor market, with the unemployment rate up about 60 bips since the cycle low. And so they've really made a lot of progress toward that, and they're far above their estimate of the neutral rate. They're over 200 basis points above their estimate of neutral. And so it basically doesn't fit to be at your peak tightness when you've actually made a lot of progress on your inflation goal, and you've started to see a bit of softness on your employment goal. And so to me, it's more about, they know that they're quite a bit away from their estimate of neutral. Let's get there a little bit faster. If we know that we need to head closer toward neutral and bring rates down, let's do it a little bit quicker, rather than sort of just for the sake of sticking with 25. So I think it surprised a lot of folks, but I do think that there's a reason behind it, and I think that it kind of makes sense with where they're headed directionally.
Okay. Yeah. Fascinating to sort of pick it apart. And there's still, the story is very much still unfolding, isn't it? Let's look to Canada just for a second. It is somewhat representative, I think you've told us, of, other countries that are more sensitive to the rate cutting cycle. The Fed clearly made this big rate cut, but there are lots of arguments about now it can just sit there. Not everyone agrees, but in places like Canada and other places that are more exposed to sort of the cutting and perhaps arguably need it more, what do you glean from that?
Yeah, Canada has been a really interesting case. Canada is important in its own right. I work closely with our managers that are based in Toronto, so I think about Canada a lot, but it can also, I've been using it as a little bit of a lead for the US, and that's because it has similarities to the US economy, but it is more interest rate sensitive, as you said, Pamela. So it has, higher levels of private sector debt and shorter duration debt, as we all know, whereas in the US, a lot of the debt is in the public sector, and we have kind of longer term debt, both on the corporate and the consumer side in the US. And so we've been looking at Canada, really, we were looking on the way up in the hiking cycle to say, okay, if Canada can, largely skirt a recession or tolerate some amount of rate hikes, then we in the US probably can as well. And so we saw what we would expect, right? Where Canadian growth saw an impact from these rate hikes, housing, the broader economy, consumer spending, all of these things. We did see that impact, a larger impact than we saw in the US, which fits with what our base case would be going in. But now actually on the other side of that, we have a Bank of Canada that we would expect is going to cut more aggressively. They already have and continue to cut more aggressively than the Fed because of all those interest rate sensitivities. And so we do wonder if, on the other side, we do start to see more of a kind of a boost or a lift to growth because of that higher interest rate sensitivity. So we're looking at it as it relates to Canada itself, but also the US, and kind of getting a read on what we should expect for the US going forward from rate cuts.
The US, and also, I mean, do you look further afield, look at other developed markets that are going through the same situation, that spent heavily during COVID, had the inflation, now are in a situation where they're cutting, but even more broadly to EM. I mean, EM is in a situation where maybe with these cuts in the US dollar has a new story to tell us.
Yeah, I think it's important to look kind of all globally. And one of the reasons for that is that if we remember, we're all coming out of this pandemic and we don't have a pandemic in our history that we study or that we model. So our approach has been, okay, if you can't find it in the history, it's not in your sample set. It's actually better. You might have luck looking to other countries globally that might be ahead in the hiking cycle. So a great example, as you said, is in EM. And in EM, we saw countries like Brazil and other Latin American countries hike much more aggressively and faster than we did in the US, and actually make quite a bit of progress on inflation. But now getting to the other side of it, we're seeing those countries start to see inflation percolate up again, which I think is an important warning sign because they're a little bit down the road from us, having started a hiking cycle a year before the US did, and then being able to bring rates down in some cases. And so looking at places like emerging markets, other places that have seen either inflation or have some interest rate sensitivity can be a good lead for the US rather than only looking at the US and our own experience, which hasn't been a great guide, I don't think.
It's a fascinating, powerful market, and we all look to the US. So it's interesting to know that you're looking here too. I find that
yes.
fascinating. Tell us a bit of the story about vol and maybe take us back to sort of how you traverse through the last couple of months. It's August, September are traditionally pretty full of vol, so there's nothing too sort of seasonally strange about that. But it is, as you say, a new time, and there are a lot of different reasons perhaps for that vol being stimulated and jumping around a bit. Is it a time to be cautious, exposed to risk, but is there a way to kind of manage these ups and downs that we have been watching?
It's a good point. So the way that I think about vol right now is kind of two factors. So the first is seasonality, which you alluded to. So in the fall, September, really anytime after August, we tend to get higher volatility, and it tends to be the most seasonally challenging time for the equity market. And then as we know, and further and deeper into the fourth quarter, we tend to see, Santa Claus rally and sort of better times. So we have that seasonality that we have come to expect. And then the second factor would be the election, which none of us really want to talk about, but typically you have, if you look at that. I'm sorry.
Yeah. Later.
The second thing is it's an election year in the US. And so if you look at something like the VIX, the volatility gauge for US equities, typically the VIX starts to move higher into the election and really through the end of the calendar year. And that's another factor that we should expect. So we had a bout of volatility in early August brought on by the July jobs report and brought on by the yen carry trade and other factors, and that has dissipated. But now, as we look out through really the end of the calendar year, we should expect vol to trend higher. So those are two factors at play. I think there are a number of other ones, like the focus on the employment markets in the US and how every jobs related print that comes out, I think market participants are really focused on, and that's contributing to volatility really in the equity and the fixed income markets.
Okay. So, and fixed income has been doing sort of what it's meant to do through some of these ups and downs?
It was for a period. So we, because of our inflation view that inflation is going to stay sticky and stubbornly around 3%, that makes us more cautious on using fixed income as a hedge reliably. So through periods, you did see fixed income work, and you saw it act as an equity hedge, for example, in early August. And then you saw fixed income yields rally through kind of September when the Fed was cutting rates, which is what's typically happened. But more recently, in the last couple of weeks, fixed income rates really throughout the entire curve start to back up again. And our takeaway for that is that the fixed income markets are realizing kind of our view, which is that inflation is still here to stay, not on a straight line down to 2%, and growth is still okay. And those factors may mean that yields should be not continuously falling, and those factors may limit the extent to which the Fed can ease from here, which may serve as more of a headwind to kind of shorter duration or kind of belly of the curve type instruments.
What might you work into the allocation mix to either help with the hedging, or how would you tackle that?
Right. So we do, and I think we talked about this last time. We still like TIPS, inflation protected securities, because of that inflation view. We look at things like what TIPS break evens are pricing relative to our inflation forecast, and they're still not fully realizing or pricing our inflation forecast. Other options of good hedges that we are thinking about are gold, for example. We've seen gold act as a pretty reliable hedge. And then on a kind of a one that we're thinking about more as well is commodities. Commodities can be a hedge to geopolitical risk, to inflation risk as well. They're very volatile. When you're talking about volatility, that's kind of front and center, but they can be a good hedge and even in kind of a small allocation in a portfolio.
Yeah, for the inflation story a little bit. It's really interesting. Just going back to the fixed income story is, I mean, what do you think of duration at this point? Do you have to kind of leave that for now, or is it just too hard to call, basically?
So it's really difficult to call duration. I think that being diversified within fixed income and having managers that are really good at picking individual credits and things like that is a great strategy. In our multi-asset portfolio, we were shorter duration than our benchmark for a long time on the view that we have resilient growth and inflation, and that is not a very pro duration backdrop. Over the summer, when we started to see growth slow and the labor market soften and inflation kind of soften temporarily and the Fed moved toward cutting rates, we moved toward more of a neutral to slightly long duration recommendation. And then we've since pared that back, and we're now neutral duration versus our benchmark. So our caution on inflation still being around and growth still being good prevents us, would want you to lean more shorter duration, but we do still have, lingering labor market concerns that prevent us from going outright shorter duration. So we're sitting neutral versus our benchmark and favoring things like TIPS within the fixed income allocation.
Fabulous. Within equities, when inflation comes down, basically when the rates get cut, it's easier for smaller companies. This is well known, the small cap story. Within talk us a little bit through the cap size allocation that you have, whether that is one of the main things that you're looking at. Do we suddenly switch to them, or is the inflation story still sloshing around enough that that's not where you go?
Yeah, there's been a lot of discussion about small caps. It's been a topic of, I think, a lot of debate internally. And so coming into the year, we did expect more of a broadening through different sectors and through down cap and globally. We're a little bit hesitant on small caps because of our rate view, that we do think that the amount that rates can rally is limited. And as you said, rates and small caps are very closely correlated. And so that leads us to be a little bit more cautious. But what we do still believe in is that broadening trade that I mentioned. So in our allocations, we've trimmed our allocations to things like quality, which have worked in the last couple of years, and more in the favor of a broad market that has more sectors and more kind of cap representation. And, that's kind of where we're leaning today. We're also thinking a lot more about that broadening into a broad and adding to our allocations in places like EM and developed market equities as well, which we have not favored over the last 18 months.
Yeah, that's fascinating. So, I mean, so the mid cap story is still of interest. And what about maybe just a bit further on the broadening story in equities? You may have already answered part of it, but it's been a big discussion this whole year of, the Mag 7, and then the broadening, which sort of worked and fits and starts and has had its own story within. Is the broadening story to the other 490 of the S&P 500 useful for you, or is there something more nuanced there you're looking at?
We do see it happening, and we do believe in that story. So we do think a lot about the business cycle, what asset classes work in different parts of the business cycle, but we also focus a lot on the earnings cycle as well. And we chatted a little bit about this last time, but we find that things like earnings revisions, so the change in next 12-month earning estimates, are a really powerful indicator of relative returns. And that's actually true for the major regions, so US, EFI, Canada, EM, and it's also true for mid cap and small cap within the US. So we've been doing a lot of work on this, and what we found is that over the last 18 months, US large cap revisions were far and away the most positive, but really over the last 4 to 6 months, we've seen an acceleration in earnings revisions in the rest of the world, especially in EM and EFI, and to some extent in Canada. And we've also seen it, not as much in small cap, but we have seen it in US mid cap. And so those trends of actually starting to see better, forward estimates. In fact, many of those regions I mentioned, their estimates are now outpacing US broad market on a 3 or couple of month view. And that's giving us more conviction that fundamentals are getting better in these other places that have been kind of stagnant for some time. And historically, that has a strong correlation with relative equity performance. So we're getting kind of more conviction and exposure to those areas.
We started out early on talking about the consumer and how the consumer is feeling, the health of the consumer, and ultimately how it fits into the business cycle. Here we are on the cusp of earnings. I'm sure you're looking at everything within the earnings story, but I'm kind of curious how you're looking for pieces of information about the consumer laced through the earnings cycle here.
Definitely, the consumer is crucial. And I think about the consumer and I try to look at the US consumer, any consumer, like a company. And that's because I work with a lot of equity and company analysts who only understand things if you kind of talk to them into that term, or more interested in things if you talk to them in that term. So I look at consumer balance sheets and their income statements. And overall, we still see a pretty good backdrop for US consumer. So on the balance sheet side, net worth is near all-time highs. It's above 2019 levels for every income cohort. So I look at every income quintile in the US. It's higher than it was a year ago. And debt is more contained than it was pre-COVID, and certainly than it was 10, 15 years ago. And so we see a solid consumer balance sheet backdrop. On the income statement side, it's a little more mixed. So we do have a softer employment market than we did a couple of quarters ago. And employment is the single biggest factor impacting the consumer. So that softness is contributing to the consumer being a little bit more selective. But overall, wages are still outpacing inflation, again, for every income cohort. And employment is still at quite healthy levels relative to history. So kind of in aggregate, we feel that the consumer is still in a good place. I've been calling it the stable but selective consumer. So consumers are okay, but they're probably going to be a little bit more picky, price sensitive, unlike the spend at any price consumer that we saw right after the pandemic.
Sorry, go ahead.
Yeah, go ahead.
Well, I was just going to ask you to spread that out to sort of the services versus goods story that also has done a few full circles since COVID, actually.
Exactly. So during COVID, goods, as we know, exploded. Goods spending was growing well above a trend because we couldn't spend on services. And then for the last 3 to 4 years, services has been the only game in town, with people spending on travel and leisure and all of these other services. And that pent up services demand has really carried spending for the last several years. We're actually expecting over the next 12 months, we might see some more action in goods again. And that's because goods tend to be rate sensitive. So even even a more moderate decline in interest rates tends to help, of course, housing, but then other derivatives of housing, home furnishing, other types of goods. And so we might expect to see that we could see spending shift a little bit more into goods and out of services, just on the margin, which would be a different trend than what we've seen over the last couple of years.
That's fascinating. What message would you like to leave with, investors, people swimming through these markets, doing their best, seeing the goods? There's lots of good to see out there. There's also a bit of a wall of worry out there. How would you like to kind of tie up perhaps your asset allocation in a bow, as it's somewhat descriptive of how you're looking at these markets?
Definitely, I would say that we're still in an expansion phase. We still have strong support from big parts of the US economy, including the consumer and the corporate sector. And we're starting to see actually better trends in the rest of the world, with better fundamentals, better earnings, easier monetary policy than we've had in a number of years. So there are always risks that are out there, but staying diversified, and overall, we think that the backdrop and the fundamental backdrop is pretty good, and is certainly better than it was a couple of years ago. So staying invested is, we think, the right option.
It's Canadian Thanksgiving coming up here, and I know it's not American Thanksgiving, but we all wish you a happy Thanksgiving.
Thank you. You too.
Thanks for joining us, Cait.